Hi, this is Geoffrey Hossie from Pair Trade Finder, and in this quick video we're going to take you through the secret of cointegration. What the heck is cointegration, and why does it matter to me? Well, to put it simply, if used correctly, cointegration, it's a mathematical principle that when applied to trading can help make you rich. Let me explain. Back in February 2015, two econometricians, Nicholas Huck and Komivi Afawuwu, published a rather extraordinary piece of research in applied economics that should interest any equity trader. Their phenomenal research is titled Pairs Trading and Selection Methods. Is Cointegration Superior? Not a very catchy title, doesn't seem like it's going to be groundbreaking, but you'll see later in this video that it is. First, a quick primer on a consistently profitable hedge fund secret. What is cointegration? Investor Dictionary defines it as, well, let me read this to you. Cointegration is an econometric technique for testing the correlation between non-stationary time series variables. If two or more series are themselves non-stationary. Are you asleep yet? Yeah, I think I faded out a bit on that one too. Basically, let's cut to the chase, and I'll explain it to you simply in the context of how it applies to your trading success. Let's take the example of a drunkard's walk. Suppose you see two drunks, representing two random walks, or two share prices, wandering around. The drunks don't know each other. They're independent, so there's no meaningful relationship between their paths. But suppose instead you have a drunk walking with her dog. This time there is a connection. What's the nature of this connection? Notice that although each path individually is still an unpredictable random walk, given the location of the drunk or the dog, we have a pretty good idea of where the other is. That is, the distance between the two is fairly predictable. For example, if the dog wanders too far away from his owner, he'll tend to move in her direction to avoid losing her, as she is the one who's going to let him into the house. If she wanders too far from the dog, she will go back to him, or she'll call to her dog to come, as she doesn't want to be woken up with the dog barking at her door. So the two stay close together despite a tendency to wander around on their own. We describe this relationship by saying that the drunk and her dog form a co-integrating pair. Now, for stocks, if stock A and stock B over time are co-integrated, it means that the price ratio, price of A over price of B, let's say 100 over 50 or 2, so 2 is likely to revert to the mean if it diverges. So if it went to 2.4, it's likely to come back to 2. If it goes to 1.6, it's likely to go back to 2. Now let's take a real life example. Let's take Murphy Oil, traded on New York Stock Exchange, and Occidental Petroleum, same thing, Oxy. And we look at a chart here of the relative performance of the last year. And that shows that whenever the performance diverges, you can see here, it's diverging. Let's see, Oxy is the green. No, Oxy is the blue, and Murphy is the green. So Murphy is overperforming versus Oxy, and their performance diverges. It then reconverges, okay? Then once again, Murphy begins overperforming, but then it reconverges, almost touches here. And that's over a 12-month period. So it diverged, reconverged. So this tendency to reconverge is something that can be traded because these are two highly liquid US equities. And this relative performance, divergence, reconvergence, or co-integrated relationship, okay, can be seen in the reversion of the Murphy-Oxy price ratio to its mean. And in this chart here, we can see we use a 100-day moving average, which is this blue line, gently rising. And the green line is a plot of the daily price ratio of Murphy over Occidental Petroleum share prices. And what you can see is that when they diverge very far away from that moving average, they reconverge. Diverge, but we didn't take a trade here. This one was a trade. We didn't take a trade here because it wasn't far enough away. Same thing here. But then again, it diverged way up, and a trade was taken, and it reconverged. Here it diverged way below, trade was taken, and it reconverged. So that is the nature of co-integration. And you shouldn't confuse that with correlation. So co-integration surpasses correlation as a pair trade selection method. In pair trading, to make a profit, we need the ratio of the prices of stock A and stock B to revert to its mean. Okay, we need this green line, when it diverges way away from its mean, to reconverge. Okay, And correlation measures the tendency of two stocks to move together. So if one goes up, the other goes up. If one goes down, the other goes down. However, two positively correlated stocks may continue to diverge despite the correlation. So you can see in this chart, stock A is prices rising, okay, over time. Stock B's price is rising over time. Stock B's price is rising less over time than stock A's price is rising over time. And if you put on a pair trade between stock A and stock B because you saw that these were diverged and you said, wow, okay, they're correlated stocks, those are going to reconverge and I can make some money on a reversion to the mean, you will have a loss. And that loss will be an ever widening loss as long as these two stocks continue to have a divergent relative price performance. So co-integration is all about finding shares that will have this green line reconverge to the blue line. As simple as that. Now, let's go back to that very important research paper we were talking about and allow us to paraphrase the holy grail findings of this technical paper. The chart in it, the summary chart, is worth 1,000 words. So let's look at this chart over here on the right. The chart shows the results of testing 3 different pair trade selection methods using the S&P 500 stock universe from August 2000 to September 2011. So that's over 10 years, every share in the S&P 500. Okay, they used 3 different methods for selecting pairs to trade. One was the distance method, DIST, D-I-S-T on the chart, here and here, which just uses correlation to select the pairs. Then they used a second method called the stationarity method, which they call STAT, here. And finally they used the co-integration method, which they called COINT, which you see here. Well, what happened? So they did 2 scenarios for each of these methods. They used a 2 standard deviation entry stretch and a 0 standard deviation exit stretch. And they used a 1-year or a 2-year look back for choosing the pairs. And what you can see from the results here is that the distance, DIST 2-year, DIST 1-year, and the stationarity, STAT 1-year, STAT 2-year, they did well. They beat the equity premium. So you did better than if you were holding the S&P 500. And they did, substantially better than the equity premium. However, the excess return generated by a co-integration based pair selection strategy is radically positive. Look at these 2 up here. Co-integration, 1-year look back for choosing pairs on a 2 and 0 exit. 2 entry, 0 exit. Look at this on a 2-year. Pretty robust because both of them are trending far, far above these other methods. What can we summarize? That with a 1-year look back, a 2 standard deviation entry stretch, and a 0 exit, a co-integration based stock pair trading strategy delivered on average 1.75% excess return per month unlevered over 134 months. That's over 11 years with a 67% win rate. Okay, those are some pretty phenomenal numbers. 134 months on average, 1.75% excess return above the market return. Okay? More importantly, if you dig down into their paper, this is not on the chart, but they used another strategy, which was a 3 standard deviation entry stretch and a 0.0 exit stretch. And the results are even more impressive, delivering on average, get this, 5.66% excess return per month, unlevered over the same period of 134 months, with 76% winning trades, so 76% win rate on their trades. That's pretty unbelievable, 5.66% over 12 years every month. That last scenario generates a capital value 10 times greater after those 11 years than if you just held the S&P 500. And most importantly, and let's just click back to this chart, with the big market crash in 2008, you'll see these strategies didn't draw down. These ones did a bit, but very little. And the equity market had a massive, massive crash at that time. So that shows you the power of pair trading and how it can make money in any market, up or down market, and how it protects you from a market crash if it's done properly. So let's just quote the authors to finalize on their paper. They say, including transaction costs, so those are built into the study, robust pair trading strategies are the following. Co-integration, whatever the length of the formation period, look back period, or the opening trigger, either 2 standard deviations or 3 standard deviations. Returns are especially high, with monthly excess returns, including transaction costs, greater than 1.38% and going up to about 5% over a period of more than 10 years. These are clearly the main and most impressive empirical findings of this article. Now that is a true hedge fund trading secret. What's the bottom line? If you have a powerful trading software that can perform the millions of calculations necessary to find pairs of highly co-integrated stocks, and if that same platform can generate simple entry and exit signals, i.e. short X, go long Y, when the ratio of X to Y is where it needs to be, and when to trade them, you can capture the potential profit these co-integrated pairs represent. Well, our software, PairTrade Finder Pro, does this job magnificently, we believe. That's what it's been designed for. It's simple and easy to learn and can protect you in the event of a market meltdown. What's more, we've done the heavy lifting, and when you subscribe to Pro, it's preloaded with an updated set of top 30 US equities pairs that are all highly co-integrated. We use as a first screen on all our pairs that we include in the top 30 equities pairs that they have a co-integration augmented Dickey Fuller result of a p-value of less than 0.10. That's the geek alert you see there. Basically, it means they're co-integrated.